Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So in this video, we're just going to do another review of velocity banking. It's going to be a continuation of the previous one. But before we get started, I just want to show you I've been playing around with AI voice generators, and it's kind of related to the topic of the video about how velocity banking is your new best friend. You ever watch those movies where it's like it starts in the middle and then the record scratches and they go, "Yep, that's me." You're probably wondering how I got into this situation, so I'm kind of copying that line and putting velocity banking into the mix. But they have really cool several, or they have lots of voices, and so they got American, British, narration. They got all kinds, so it's really cool. So let's go ahead and just play this.
Yup, that's me. You're probably wondering how I got into this situation and how velocity banking became my new best friend.
Let's generate it with another person, Bill.
Yup, that's me. You're probably wondering how I got into this situation and how velocity banking became my new best friend.
Oh, sounds sophisticated. A little bit more sophisticated. Let's try the upbeat British voice.
Yep, that's me. You're probably wondering how I got into this situation and how velocity banking became my new best friend.
Oh, I love how she says that. How velocity banking became my new best friend. And so, I actually also drew, been playing around with AI images. So on Meta AI, you can type in like, "Can you draw?" It's where I got all the images to post on the YouTube community feed, like Doctor Doom with a credit card. So this one I put, "Can you draw a line of credit as your best friend?" And then I got this guy. So apparently this guy's name is a line of credit, Line Ling Credit. Ling is his middle name, and he can't even spell his own last. But this is what line of credit looks like according to Meta AI. So why is our line of credit new best friend? Because there's something called the segregation of income, and this is the exact same situation we went over in the last video, but let's just emphasize why our line of credit would be our best friend. Because when we make more money, we're going to be able to handle more debt, right? And so what velocity banking is a debt and cash flow management strategy. And a lot of people, and again, I keep trying to explain this, but I get the same comment over and over again. What about if you're poor? Here's the thing. If you're poor, nobody's going to lend you money, right? Because banks don't lend money to people who need it. But when you do make money, you probably are going to take on some debt because let's say, it's a lot harder to save up an entire 200 to $400,000 for one house than to, just put a 20% down payment and borrow the rest, right? But a lot of people are like, well, what can you do this if you're poor? And the answer is banks don't lend money to people who need it. In fact, I remember hearing a statistic for more than like 10 years now about like how 80% of the population can get a mortgage, right? And I think right now it's like 90%. So if 90% of the population can't get a mortgage, they probably are not going to be able to obtain debt because banks don't want to lend to them, right? We got to be a little bit realistic. And the other thing that we have to be considerate about is that, hey, don't limit ourselves into thinking that we're poor or that we can't make more money. If we can complain on the internet or have the energy to complain on the internet, we can certainly do a little bit of hustle, make a few YouTube videos, and then once we make enough money, then we can responsibly take on debt, right? So let's just go over here. Again, same situation where we're negative cash flowing. $9,000 of income, $9,644.48. Ooh, this is a doozy, right? This is a doozy. And we got the 10 credit cards. Now, if you've been watching this videos, you know exactly what to do, right? You know exactly what to do. And one credit card, or 10 credit cards, and one mortgage, and we have our other food, gas, insurance, and all that. But right now, we can't get a line of credit because when is the best time to get a line of credit? Before you ever need it. And it's the same philosophy with friendships. Sometimes I think people have a very wrong philosophy with friendships where they just want to talk to you if they can use you. And I've been in Los Angeles. I've lived there for a couple of years, and they're masters at that, right? Transactional relationships. Apparently, the city of Atlanta has kind of followed the Los Angeles model of friendships where it's just all transactional. But luckily, I don't stay too close to there. But a lot of people have been complaining about Atlanta for the past couple of years, and I think there's just because there's just, it's too Hollywood now. Now, what's my point regarding all of this? Well, you always want to get the things that you need before you ever need it. So if you're in the situation where you have $9,000 of income and you're negative cash flow and you're thinking, oh my goodness, I could use my best friend, aka the line of credit now. People, the bank is almost like kind of like just a regular Joe in the sense that, hey, if you need the bank when you're in trouble, they ain't gonna be there for you. Just like, any regular Joe, if you only reach out to them when rather than trying to maintain and build that friendship over a long period of time, if you only reach out to them when they need help, they're going to feel used, right? So it's important that we get the line of credit before we ever need it. And again, if we're into velocity banking, we need to do two things. So number one is the budget, we need the budget, and then number two is a line of credit, and we're going to make that as our main operating account. So what is a line of credit? All it is a financial tool where you could borrow money, pay it back, and then we use it over and over again, right? Unlike a loan, which is just a one-way street, right? And some people love that loans have lower interest rates, but we can use a higher interest line of credit as long as we use it responsibly, right? And I don't mind the higher interest rate because I probably need to show a screenshot of my last HELOC statement where I had like 20 grand of movement with payments and I only pay like $12 in interest, but it's a 10% line of credit. So the 10% doesn't bother me as much as the actual interest that I paid, right? That's the most important thing, the interest that I paid, not the 10% interest rate. People kind of they always like get so hung up on the interest rate, right? So let's just assume that yeah, we did get the line of credit before we ever needed it, 200,000, right? And again, some people claim, well, where do you get a line of credit? You just have them laying around? And the answer is, if you do it right, then yes, right? So, for example, I have this personal line of credit with the credit union. They have an office here in Georgia, but it's originally from California, and then it's just 15,000 available to me, right? 15,000 where I just go to a bank's website, I click the button, and then cash is in my checking account in an instant. I'm like blown away. Like, I can't believe how easy that is. But again, it's because you build the relationship, and it's the same rules with human friendships, right? Real life friendships. You build the relationship, um, whether in good times or bad times, but you don't just reach out to them like, I'm in emergency, like I need money. Then you seem almost like a scumbag, right? Which we don't want to do. All right, or B. Okay, I don't. Oh man, I probably need an AI voice assistant to help me with this. I would love a British AI voice companion because I cannot do a British voice. I'll love it. Okay, so we assume two things: the same income, right? And then the savings, which will actually go to zero. So right here, we're negative savings, but we're going to be zero savings at pretty much all times because our savings account or checking account is not going to be our main operating account. Those are three words you got to memorize. Main operating account, MOA. Made that up. But MOA, main operating account. And then what we're going to do is we're going to just copy these expenses, right? Just copy them. And then what we're going to do is we're going to have something called cash flow, which is income minus expenses. And you might be looking at this as all you did was shift the numbers, right? That's what Dave Ramsey complains about HELOCs. Like, you just shifted debt. No, no, no. Because we didn't complete the final step, which is the actual velocity banking part where your income goes into the line of credit and then your expenses come out of the line of credit, right? You dump your entire, oh, did I even do this right? So let's just do this. Expenses out of line of credit. Ugh, I can't even type anymore. Okay, expenses out of line of credit. Okay, that's the most important part when you make your line of credit as your main operating account. And at this time, when you see that you do have a line of credit, it's like, oh my goodness, this is my best friend, right? Because once you make it the main operating account, then this will turn into a huge positive number. And done this many, many times. So we got 10 credit cards, $167,000 of debt in the credit card, right? So let's do 167000, and then we go here, and just by simply transferring this debt, right? What happens to the payments here? 0, 0, 0, 0, 0, 0, 0, 0, right? And now we have a cash flow of $4,701.35. Amazing, right? So we went from a terrible situation to a positive situation, even though we have $167,000 of debt, right? And just because you have a line of credit doesn't mean you're gonna turn out positive, because think about how most people would use a line of credit. So instead of making it our main operating account, right? So let's just kind of reverse this. Instead of making it our main operating account, this would be 0 right now. What they would do is, in this situation, okay, let's say we're at negative 644, but your car breaks. Your car broke down. Oh, well, okay, well, I'm going to need the line of credit, but you're not going to use it in a way that's going to benefit you. You're going to use it in a way that benefits the bank, because you're going to have even more negative savings. They get trapped. They're going to charge you more overdraft fees. Oh my goodness, that's crazy. Okay, so now let's say that you had a $3,000 car emergency, right? You borrow it from the line of credit, and guess what? Because your checking or savings account is your main operating account, you have an extra $50 payment from that $3,000 line of credit, and now you're in more negative savings territory, right? Like, you were in negative savings territory before, now you're in more negative savings territory. I don't even know if that's the right word. More negative, negative. I don't know. Negative is a positive, so that's not the right way to say it. But what I'm saying is that you were at negative 644. Now you're at negative 690, just because you borrowed money from your line of credit, right? So we don't want to just have a line of credit available. We got to make the line of credit as our main operating account, and we have 0 savings, right? And so now, just by simply transferring this debt, let's go ahead and do that. And let's go ahead and 0, 0, 0, 0, 0, 0, 0. Repeat that one more time. Oh, did I skip? All right, there we go. And then now we have this $4,701 cash flow. We put $9,000 in the balance here, and then go down by $4,298.65. And then after every single month, you subtract, the balance is going to go down by $4,700 plus the interest. And again, if you don't know what I'm doing, just memorize these 3 formulas. You get the next month, which is the previous month, plus 1, next month's balance, which is the previous month's balance, plus the previous month's interest, minus this cash flow number, 47001.35. And then what you do, you need to get the interest, you got to estimate it with the average daily balance, which is what we're going to do right here. Okay, and then we multiply it by the interest rate, 0.1. Why do we have 0.1? Because that's 10%. And then, because interest is quoted annually but actually calculated monthly, you divide by 12, right? And then copy and paste these, and then bam, we just do Control V, and then we just kind of do Shift and copy and do this, and then so now at 43 months, bam, we got this $167,000 debt paid off, right? See how easy that was? Because we had a line of credit, and if we didn't have a line of credit available, oh my goodness, it would be so hard. I'd be like, what am I doing with my life? Now we simply paid off that $167,000 credit card debt in about 43 months, right? So 43 months. So bam. Now at this point, because you have so much cash flow, what do? You can invest in real estate. Maybe you want to just buy yourself a home. Well, actually, we got a home here. It's a 1798.65, $300,000 loan. So we have $4,700 that's going to be in our bank account, and we can attack the mortgage, right? And we should definitely attack the mortgage eventually. Now, some people might disagree with that, because they say, well, if you got a 3% interest rate on a mortgage, but you could get a 12% return on the market, why wouldn't you do that? And hey, if you can do that, that's fantastic. I just don't know anything about stocks. I'm gonna be honest with you, or crypto. But I know people who made a lot of money in that, and I have no idea what's even going on. So I like to invest in real estate, but I'm doing like one house at a time. And one of the cool things about real estate is you can buy it at a discount. It's like a $300,000 home for $200,000, right? And then let's say you pay off that $200,000 home. Oh, that's an extra source of cash flow or income, because I don't know if you knew this or not, but most real estate doesn't cash flow. It doesn't, right? So good cash flow in real estate is about $200 a month, and that's crazy how it's like $200 a month is considered good cash flow because like I don't know. I got the impression from reading like Robert Kiyosaki, Rich Dad Poor Dad. Oh, like I could borrow all the money I want, and then like I'm gonna have this awesome cash flowing property, which is probably not true. You gotta pay off the debt, and here's another reason why you gotta pay off the debt, right? Not net loan amortization. So if we go ahead and do this, right? So we have a $300,000 loan at 30 years at 6%, right? Take a look at the amount of interest that you pay. It's a $300,000 loan, but the interest that you pay is more than the loan itself. So how many houses are you kind of giving away? You're giving away like a little bit more than one, assuming this is 100% finance, right? So if you get one of those like low down payment loans, like 1 or 0%, I don't know if 0% actually exists. I think 1 to 3 exists. You give a low down payment and the interest rate is 6%, like you're paying for essentially two houses, right? So we definitely want to pay this off unless you can make a lot more money, then maybe we don't. But again, um, most people are broke, so I'm assuming that they're not going to be that. I don't want to say literate, financially literate, but I can't think of another word. But they're not. They're not. Hmm. Are they going to make? Okay, I don't know how to phrase this, but we'll just assume that maybe they are smarter than me, but I'm just saying for myself, I'm not that smart, right? I'm not that smart where I know how to like make money in the stock market and probably lose money if I put it in the stock market, so I don't put it in there. But at least with real estate, if we pay down this debt, we get an extra $1,700 in cash flow, and if we pay it off early, we don't have to pay this $347,000 in interest, which is kind of like the main thing where it's like, whoa, I can't believe I paid double for the house after 30 years, right? So at this stage, again, we have this $4,700 in cash flow. So we have two options, right? So what's option one is use savings to directly pay the loan, right? That's option number one, and that's the default option. So how many people do you think would use the default option to pay extra payments on the loan, right? So let's say you have $4,000 on a $300,000 loan. Okay, I'm going to dump all that $4,000 into that loan. How many people do you really think are going to do that? The answer is almost nobody, right? Because they have the statistics to know that most people either resell their home 5 to 7 years or refi. So that 30-year loan essentially became a 37-year rather than a 7-year loan. And if people knew, like this is the option that they already know. So why didn't they do that? Because of their need to have a savings account, right? What if you have emergencies? Don't overpay your loan. So, but if we have lines of credit, we can essentially just overpay it and make it easy for us, right? Easy is the right word, and do it have the same effect as overpaying our loan directly. Oh, like, but again, the most important part about this is that we understand the order of debt payoff, that credit cards come first, at least in this situation, then probably auto loan, then a student loan, and then the mortgage. The mortgage is the one we want to attack last, right? Because think about it. I paid off all these credit cards, $167,000, and I got $4,000 cash flow back. Now, what I can do is if I do it the debt pay off the wrong order, I could pay the mortgage off first, right? And only get 1,800 back. How's that work in terms of cash flow? No, no, no. That's why we pay off the mortgage last. So option number two is what we call chunking. So basically, transfer small portions of that principal to the line of credit, right? And it's really simple, right? So all you have to do is just take a small amount. So let's say we take like $10,000, 10K or 20K, and we have a velocity banking calculator for this, and then just move it to the line of credit. So this would actually be 290K, right? And then move it to the line of credit, and then again, the strategy, do it again. Income in, expenses out, and as long as you have the cash flow, it doesn't really matter, right? So that's the most important thing about this concept. So $10,000, right? and then you see in 2 months it pays off. Maybe we just do 20. I don't know. Let's do 20, right? And then you could see 5 months it pays off, right? So just as long as you have the cash flow, it's really all that matters. And if we do 10,000, look, I mean, we don't even pay that much interest, like $40. And you do $10,000 chunks, it's fine. If you want to do a bigger chunk, right? Because you don't want to have to remember, oh, I got to rechunk again every couple of months, which honestly, it's not that big of a deal if it's every 2 or 3 months. But maybe you want to do it every 6 months. So you say, oh, I'm going to 20,000, right? You're going to have to pay a little bit more interest because you're carrying the part of that loan in a higher interest rate environment, which is why, when I talk about chunking, you just do a small amount, kind of like similar to your paycheck, once you maximize your cash flow. And if you want to see how long it takes to pay it off, then I'll open this velocity banking calculator provided by Renatus. And if you don't know what Renatus is, let me just type in Renatus velocity banking, right? So you see Renatus Financial Freedom, and they actually have a velocity banking app, believe it or not. If you go in here, right? So basically, they have an app. It's only on the Google Store. I'm not the Apple Store because I click this link, I get an error. But hey, if you got the Apple Store, they have an app. You can just put in their information, and that's pretty much it. And then it'll do the whole thing for you. But the bad thing is because it doesn't save your information. Every time you open the app, you got to do it over and over again. But yeah, you go to My Renatus, and then this is the person that I originally learned it from, which is Randall, and I've talked to Randall online before, but I don't think he knows this is me because I don't know some of these people like really, really well, and a lot of times I just use online personas to communicate with people. Anyways, so it's where I originally learned velocity banking from, and Randall here made this cool calculator called the velocity banking calculator. Isn't that a cool name for a calculator? But let me go ahead and open it up. Give me one moment. So here we are with our velocity banking calculator. All I got to do is just put in the information here, right? So what's our original balance, which is $300,000? What's our current balance? I just take a look here. And how long did it take us to pay off the loan or the credit cards? 43 months. 43 months. So let's take a look here at when 43 months is. 43 months right here. So 285,000. So I just copy and paste this right here. Okay, so now what's the interest rate? It is 6.30, and what is the payment amount? 1798.65. Haha. All right. So this is the chunk amount, which is how much are you going to move to the line of credit? And then let's go ahead and put our extremely high income that people will complain about, $9,000. 9000, and then expenses, everything except for the loan we're trying to pay off. And so we have our general expenses. We got the mortgage right here, so 2500. Let's go ahead and write 2500. And then as you can see here, again, the chunk amount is just how much we're moving from the principal to the loan to the line of credit. And then we just rinse and repeat, do it over and over again. And so what we do is just do 10,000. We did that as a starting baseline, and you can see it pays off in 4.2 years, right? $38,000 of interest. We didn't pay the insane, double the interest, and it doesn't take into account the interest we paid before the 285. But again, from that point, we still saved a lot of money, right? And let's say we do 20,000, right? 20000. How much more do we have to pay? Let's take a look. 4.2 and 38,000, about 1 grand more, right? So again, the only reason that you just chunk more is because or put more into the line of credit is just so that it's really for convenience reasons, and that's essentially why you pay more in finance, or any reason you pay more in finance, because you just don't want to have to deal with it every, let's say, 2 to 3 months. You do a chunk of 20,000, and then let's say you pay it off in 6 months. The pay I'm sorry, the time to pay it off will be a lot soon. Will be the same, but the interest will be a little bit more, like marginally more. Let's see what happens when we do 50,000, because I'm pretty sure there's going to be a limit here. So 50,000. Yeah, see. But ironically, the payoff time goes a little bit shorter. That's interesting, right? But let me just do 10,000. Okay, so 38,000, and let's see what happens when we have a 30% credit card when we do this. Worst case scenario, right? 43. So 43, that's really interesting, right? And then another thing to note is, let's say we do a 10% and then we do that thing that the internet talks about, which is replace our mortgage with a line of credit, our, lower percent mortgage, 285,712.64. Now let's take a look here and here. I'm going to hit enter now. Look how it doubled, right? So the payoff time was almost very similar, but a little bit more. But look how that doubled. Yeah, I saved money, but I kind of left half the money off the table by doing a first lien HELOC. And why would you want to do that, right? Like, if I pay a little bit more, so if I go from 10 to 20 and I pay a little bit more, I think I might be okay with that. But if I doubled the amount that I pay in interest, and I actually it takes me a little bit longer, I'm like, no, thank you. No, thank you. No, thank you. All right. Well, so let's go ahead and write this down. Look how easy that was. So 43 divided by 12 plus 4.3. Is there 4.2 or 4.3? Where am I? Where am I? Where am I? I don't know where. 4.2. All right. So 4.2. And now it's 7.78 years and we're debt free. We're debt free. Oh my goodness. 467K of debt and 7. I totally even forgot. 7.78. So four I gotta write that down right here because I'm gonna forget right after as I'm typing. So 467K of debt and 7.7 years debt free, right? And it's because of our new best friend that we have available called the line of credit, right? And this is what, according to AI, what the line link credit looks like. All right, well, that's it for today. Just another review of yesterday's situation. And again, if you're not, I know a lot of people are not making that money, but guess what? 90% of people in this country can't even get a mortgage, right? Isn't that crazy? And so people get like really offended. It was like, dude, debt is only for people who can afford it. And so that's why if you're not at that stage in life where you can get debt or people will lend to you, you have to focus as much as you can on making the income. And then once you make the income, people will lend to you. But the problem is that, the finance industry is just kind of like the pharmaceutical industry, right? Big pharma's best customer is not someone who's going to die tomorrow, right? Just like big banks' best customer is not someone who's poor. Like they want someone who's rich, but they're kind of being drained out of their income and then made to feel poor, right? Okay, well, that's it for today.